Hi viewers, how are you all? So today we are on the website of investopedia.com, and on this website we have got to read about investment strategies for extremely volatile markets, right? So let's find out. It's a very important topic to learn, and more importantly, it's very necessary if you are into business and all, right? So let's see how we can go for it. Most investors are aware that the market undergoes periods of both full runs and downturns. So what happens during periods of extreme market volatility? Making the wrong moves could wipe out previous gains and more. By using either non-directional or probability-based trading methods, investors may be able to protect their assets from potential losses and may be able to profit from rising volatility using certain strategies. Volatility versus risk. It's important to understand the difference between volatility and risk before deciding on a trading method. Volatility in the financial markets is the quantification of the speed and magnitude of an asset's price swings. Any asset that sees its market price move over time has some level of volatility. The greater the volatility, the larger and more frequent these swings are. Risk, on the other hand, is the possibility of losing some or all of an investment. There are several types of risks that can lead to a potential loss, including market risks, that is, that prices will move against you. As the volatility of the market increases, market risk also tends to increase. In response, there can be a marked increase in the volume of trades during these periods and a corresponding decrease in the holding periods of positions. In addition, hypersensitivity to news is often reflected in prices during times of extreme volatility as the market overreacts. Thus, increased volatility can correspond with larger and more frequent downswings, which presents market risk for investors. Luckily, volatility can be hedged away to some degree. Moreover, there are ways to actually profit directly from volatility increase. Hedging against volatility. Perhaps the most important thing for most long-term investors is hedge against downside losses when market turns volatile. One way to do this, of course, is to sell shares or set stop loss orders to automatically sell them when price fall by a certain amount. This, however, can create taxable events and moreover remove the investments from one's portfolio. For a buy and hold investor, this is often not the best course of action. Instead, investors can buy protective put options on either the single stocks they hold or on a broader index such as the S&P 500, for example via S&P 500 ETF options. A put option gives the holder the right but not the obligation to sell shares of the underlying as a set price on or before the contract expires. Say that XYZ stock is trading at $100 per share and you wish to protect against losses beyond 20%. You can buy an 80 strike put which grants the right to sell shares at $80 even if the market falls to say $50. This effectively sets a price floor. Trading volatility. Investors who wish to take a directional bet on volatility itself can trade ETFs or ETNs that track a volatility index. One such index is the volatility index VIX created by CBOE, which tracks the volatility of S&P 500 index, also known as the peer index, the VIX. And related products increase in value when volatility goes up. You may also consider buying options contracts to profit from rising volatility in addition to hedging your downside. Options prices are closely linked to volatility and will increase along with volatility because volatile markets can lead to swings both upwards and downwards as prices gyrate. Buying a straddle or strangle are popular strategies. These both involve simultaneously buying a call and a put on the same underlying for the same expiration. If prices move a great deal, either strategy can increase in value. Thank you so much, guys, for coming up to end of this video. See you soon. Before then, in the next video. Before that, subscribe my channel, press the bell icon for more updates. Bye bye. Take care.